What if I told you that the latest US jobs report, the one everyone is celebrating, might actually be the trigger for the next major market shakeup? September non-farm payrolls came in at 119,000 new jobs, beating expectations easily. Yet, unemployment jumped to 4.4%, the highest in 4 years. How can those two numbers both be true? And more importantly, what are they really signaling to the market? Let us break this down. Normally, when job creation beats expectations, unemployment should fall. But this time, unemployment spiked while jobs increased, meaning something deeper is happening beneath the surface. This is not healthy growth. This is a structural crack. The surge in unemployment shows that more people are entering the labor market than the economy can absorb. And the jobs being added are not the same types of jobs being lost. Higher paying positions in techs, manufacturing and corporate roles are shrinking, while the gains are coming from low-wage, temporary or part-time work. So yes, the headline looks strong, but the foundation is weakening. In a high-rate environment, this matters more than ever. Weakening labor income leads to softer consumer spending, weaker tax revenue, and heavier debt pressure. That is a problem when the US is already dealing with massive treasury issuance and rising debt service costs. If the labor market weakens at the exact moment the government needs strong growth to stabilize that is a dangerous setup. Now, shift to the equity markets. Short-term traders will chase the headline jobs, beat expectations risk on, but longer-term capital is watching. Unemployment wage cooling and participation rates, not the headline number. If unemployment keeps rising, the path for rate cuts become less predictable, not more. And when rate expectations wobble, valuation-heavy sectors like tech and AI become extremely fragile. So, the real question for equity investors is simple. Is the market pricing real economic strength or just clinging to a narrative? Because right now, the market is approaching a fork in the road. Another squeeze higher driven by liquidity hopes, or a sharp repricing once macro reality becomes unavoidable. And quiet capital is already positioning defensively, trimming high beta tech and adding duration exposure. So, here is the core takeaway. This is not a sign of recovery, it is a sign of stress. The economy is holding together with surface-level numbers, but the underlying structure is weakening. Over the next 2 or 3 months, expect elevated volatility, range-bound trading, and a potential reset heading into year-end. If you want to stay ahead, watch unemployment wage growth and participation rates, not just non-farm payroll headlines. Subscribe. We cut through noise and help you position before the market moves. Do not get caught reacting when others are already preparing.